are leading and driving government's agenda is concerned, and Power Grid is set to benefit from the increasing transmission capex. However, what the HLPC analyst is highlighting is that most of the new upcoming projects, especially in the renewable energy space, would happen at more dilutive ROEs, and that is something that he is flagging off as a risk on the horizon.
All right, thanks a lot for that. We have the market opening, which is just going to kick in right now. There's about 30 seconds left. And looks like it's not a bad, opening for the market, because remember, the US markets also picked up a tad bit overnight. So you have those cues. And then apart from that, a lot of pockets have started to see a little bit of a recovery. And the October series historically has been very good for the markets. The last 3-year returns has been about, I think, 1.5% to about even 8% on the October series. So maybe this time history repeats itself, you never know. But here you have it. The first tick on the index is in the green, 60 points higher. Going by the positive global cues, our own markets have also opened well in the green. The mid-cap index is up about 160 points. The Bank Nifty is well in the green, up about 130 points. So it's a good start to trade. What's leading from the front is metal stocks. Hindalco, Tata Steel, JSW Steel are up about 1% to 2% to 3% apiece. M&M is also up about 1%, so looking pretty good over there. NTPC, Tata Consumer Products, L&T and Divi's Labs are a couple of other stocks that are trending in the green. On the downside, Tech Mahindra is a tad bit soft in Infosys as well after Accenture's numbers. TCS too, so that whole pocket, TCS, Wipro, Tech Mahindra, Infosys in the red, while Power Grid is one stock that is also trending in the red at the moment. So, that's another stock to look at. But otherwise, it's a good, strong opening for the market. And the Nifty is holding on to gains of around 19,560 or 590 actually at the moment. But what about the Rodham? I think Naveen Fluorine stands out, right?
Well, that's right. Sonia, the start actually for the Nifty is good. It has the ingredients to have a good session today. So let's hope that does happen from a bullish perspective. Yesterday, we ended at the low point of the day trade. The Nifty is bouncing back. Naveen Fluorine, you have the resignation coming in from the MD, who was one of the key people who were driving the company. The stock is down close to around 9.5%. MCX. They were expected to go live. Now, in fact, there's a bit of a postponement out there. So that stock as well is down close to 5.5%. Persistent is down close to around 1%. Yesterday, we had a big cut actually on Tech Mahindra. But today as well, we're having the market down close to around, close to around 1% or thereabouts. Tube Investment, Nimesha told us, is likely to be a large trade. And 1% equity has changed hands as well. So keep an eye out on that one. We'll try to get you further clarity with regard to who participated in that. Oro Pharma from the F&O basket, well, that's flying away. It's up close to around 5.5% as we speak. So big up move is what we're seeing on that one. Whirlpool as well, up close to around 2.5% or thereabouts. A couple of other notable movers today. You have Central Bank of India in terms of high volume movers. That's up close to around 2.5%. And Nalco as well, pulling back. Last few sessions, it's been seeing some selling. Today it opens up with a gain of around 1.5%.
Okay, well, things are looking pretty steady. And of course, the damage in individual stocks is on expected lines as well on the back of news flow. So we'll pick up more on some of these names in a bit from now. But our market master is ready with us. Samir Arora is founder and fund manager of Helios Capital. He's joining us right now. Samir, good to have you with us here. Thank you very much for your time. We got a bit of a shakeout both in the US and not so much in India. But in the US, 10% of the NASDAQ is not small, but what's your sense? Because you got a broader sense of things. Have US also making a bit of a trading bottom in your opinion? And what are the implications for the market here, in your opinion?
I think India is trying a bit too hard in trying to hold the market up in some sectors and in some areas. But for US, if you look at it on a year-to-date basis, the market is still very strong. So somewhere along the line in the last 8 months, something would have happened, whether it happened all in 1 month or over 2-3 months. So I'm not that worried. But, the US, I'm amazed that the US markets felt even till 2 months ago that the interest rates will be cut soon, when the Federal Reserve again and again said higher for longer and stuff like that. So if we take US as sort of given for now for us, I think in India, some of these stocks, particularly in tech and in some of these small caps and in some of these sectors, I think are a bit wild, and they will also have to give back, just like NASDAQ had to give back.
Samir, hi, good morning. Good speaking with you after a while. What
Yes,
about what's
how are you?
happening? I'm well, thank you. But what about what's happening here in the Indian markets? It's very interesting because we are at lifetime highs. But now looks like the train is not moving forward. You think it's because of Brent crude prices, because of the upcoming general elections? I mean, what do you think is stalling this market now?
So first of all, I don't think the market actually has gone up a lot. If you look at it on a calendar basis, which means it is up, say, I think NSE 500 is up, I think 12% or something, which is more or less in line with our annualized returns over the past 5, 10, 15 years, which are, say, 14%, 13% per annum. If you also add last year's numbers, which were only up 4%, then in 20 months, you are up less than 1% a month. It's the mid-cap, small-cap, which have had this rally, and particularly from March. So they need to correct a little bit. I don't think the larger stocks are in any way signaling that they are all-time high. In fact, the banking sector is down. IT sector is up, but should be down, according to me. So in general, I would think there is some difference within different sectors, and some of them will correct and some of it may be justified. But overall, you can't be nervous about the market.
Hi, Samir. Good morning. Samir, you said it, right? The party has been in the broader markets, the mid and the small cap space. But the biggest heavyweight hasn't performed. HDFC Bank. Has its time come now? Everything is looking like it's perfectly in place, but the stock is still not performing. What's your take on it?
We like it a lot and it will perform, but you have to position it correctly. So, we have these two categories of stocks. One is where we think that it will do a little bit better than the market, which we call high confidence in reasonable return. I think that you can take it as nearly guaranteed, because one day the market will fall 3% and this stock will be up 2% and it would have outperformed the market. Point is, even last year when it looks that it didn't do anything, NSE 500 was up 4%. And HDFC Bank was up 11%. So we are not going to expect 30% returns from this stock, but a portfolio needs both kinds. Unless you are a small cap fund and want to be a 2-year wonder kind of a fund that, you do well for 2 years, raise a lot of money, then down 50%, like it happened in 2018. But for any diversified fund or any fund which wants to be consistent across periods, you can't only have the biggest bangers at the same time. You need a sort of a combo, and we position it as high confidence in reasonable return. And in reasonable return, which means beating the market by a small extent, we are very confident.
Samir, you've had a slightly negative view on autos for some time, right? With all the disruption, etc., which is happening.
Always.
Do you still think that will be the case, or I mean, the space not done badly, but the market's not done badly, so it's kind of come up with everything else.
Actually, that is the thing. The beauty of this market is, and all markets, is that many stocks do well. If you don't like something, just ignore it. Whether it works or not doesn't matter, because it doesn't take away much from your opportunity set. We philosophically don't like it, because we philosophically don't like betting on things that nobody knows about, and then betting on 1 month numbers when you don't know exactly the bigger picture of EV versus cars. And in general, in India also, if you see the cars which are, I saw a report from one broker that cars which are priced less than 7 lakhs, the numbers are, I think, at COVID type lows. It's only the top 10%, 15% of the Indian public and the top selling everything, cars and everything else, which are doing well. By the way, we own Landmark since IPO day, and it's up some 70-80%. So indirectly, directly, there are many ways to do it. But I don't believe in the overall car story, because I don't believe that companies putting billions of dollars into EV are adding anything to the industry, because they're just having to switch from IC car to EV car without any economic gain to everybody, except the wider climate and things like that, but not to the companies that aggregate. And then somebody might win in that, but who knows today who will be that winner.
You mentioned that data point, right? So cheaper cars, there are no such thing as cheaper cars now, but valued under 7 lakh rupees.
Lower. Yeah.
Lower price. They're doing poorly. And that is true across a range of other things.
Everything.
Now, but the point is, Samir, so that has got to show up in retail credit, etc. as well, right? I mean, yesterday RBI released retail credit numbers for the month of August. If you look at the retail credit growth is steady, some 18%, but the piece which is doing well is mortgage. Everything else is down. little bit. But the point is, it's not growing.
Actually, there is a bit of a slowdown in everything. And therefore, now you'll have to be more and more particular about things and companies that can stand it. And anybody doing single line lending or single line growth, you'll have to be more nervous for some time till we get comfortable again that all this is still in control. Yes, absolutely right.
But do you think this is just inflationary impact, or is there? Because if you go back a few years, going into COVID also, there was a bit of a slowdown, if you remember. And then, of course, the next couple of years were, it kind of was all over the place, and we managed the situation well. But yeah, is it just inflation or more structural?
I think the way to look at it is that everything should be compared to pre-COVID and assume normalized growth from there, rather than in places where there was very rapid growth. In nearly every place, even in US, even in India, most of the rapid growth has become normalized, and normalized not that you can continue to grow, but the 5-year numbers, 4-year numbers will become as if there was no COVID, or maybe 1% here or there for some particularly sectors that were benefited. But in general, over this period, because of COVID, primarily, I think that the loss of savings and the loss of income was so high that people have not recovered. And therefore, this disparity has increased. It's in all the stocks we look for, whether the middle class or the upper middle class or the rich class are the buyers, then we feel more comfortable right now.
The space to be in, at least that's what the stock performances are showing, is this entire power, renewable energy, capital goods space, right? And historically, if you map it in the run-up to general elections, when spending picks up as well, the capex cycle recovers. But do you think this is just cyclical in nature, or is this some sort of a structural up move that you're seeing? And are you partaking in it in any way?
Well, we have NTPC, but otherwise we don't have any of these things. But in general, the thing is that after COVID or pre-COVID, the government deficit used to be, I forget even now, but must have been 3-point-some% with a plan to go towards 3%, and then it went up to 9-odd%. And then slowly it's back to whatever 6%. But someday after elections, the government will have to announce the new fiscal path, and that path will naturally lead to some 0.5% per annum decline in fiscal deficit or some map like that. And therefore, I think that after elections and for next year, that is 24-25, the government spending cannot be as high as it is now. And, the base would be high. And also many of these projects, because of completing them in this 5-year cycle, would have been completed or near completed. So there is no way that the same thing can continue. And, this idea of cyclical versus this thing, for many of these infra type projects and investments, it is always cyclical because governments never have continuous money at all the times to be able to keep up with the space. Even the tax increases, they might be very high, but then on this base, can we imagine another 20% growth? It's very difficult to imagine.
Actually,
therefore, in some sense, they are cyclical.
No, let me try and maybe rephrase that question, right? Are we in that 2003 to 2007 phase? I remember at that time, the sort of these capital goods, stocks, power stocks, etc., had seen a 3-4 year upcycle. So do you think this is the start of that kind of an upcycle?
I don't think it is the start.
No, okay.
Because that, the returns there were 40% per annum for 4 years. And in theory, you could have turned bearish 1 year before and you would have been better off than playing it till the end. So if you think this is it 2003? Oh my God, that is too much to dream. I think let's not go that way or that far. The equity market guys do not need such aggressive dreams or such aggressive returns. The idea is equity markets in general in India give 14%, 13% return per annum. These returns are in line with the earnings growth, in line with nominal GDP growth, in line with risk premium over fixed income. These returns are higher than what you normally make in fixed income, than returns you make in gold, returns that you make in property. And that is this game. If you make too much more, you will have to give up some of that. But the point is today, if you look at this calendar year or you look at last 20 months, particularly if you look at last 20 months in dollars, these returns are not, we haven't even got our normal annualized numbers. In addition, we have a marginal or a serious shift of some interest from China into India. Plus, we have domestic flows, which used to be not there, say, 5-6 years ago or before 17. So therefore, you have higher expectation, higher confidence that you can make the 13, 14, 15% index return. That is actually enough for somebody to allocate as much as they can. And if it goes much more, initially you take it with pleasure and then you get nervous later on.
Samir, last couple of questions before we let you go. Share us some new ideas. I recall when you had bought some of these new age companies, I think Paytm, Zomato. Share us something new that you have added to the portfolio.
So
and
now the
continue
thing
to
is,
hold these. Yeah.
We continue to hold, and very soon, one day we'll have a mutual fund. So once you buy that, you will see new ideas in it. Why should we not take it today?
Is this a pitch, Samir?
Now it's a
Solid
small
pitch.
entry cost. Small entry cost to see the new ideas. Sometime down in the next 1 month or 1.5 months, we'll be there.
I could be on board that one.
Thank you. Everybody listen to him.
Could be.
All right, Samir. Yeah, he's not committing. He's not committing.
I don't know if Samir is toying with you or you're toying with Samir, but anyway. Samir, but seriously, anything incremental, anything new you've kind of put your money behind recently? Nothing.
The team, nothing new that we bought in our current funds, basically the same. We just enjoyed not having IT because I was getting nervous. Now I am confident that I can pass the next 6 months very peacefully again. So it's all good.
All good. All right. Fair enough. We'll leave it there, Samir. Great speaking with you and appreciate you coming on board and sharing those insights with us. Well, 40 points higher is what we have on the Nifty. 19,561 is where we are at. Now, this is a CNBC-TV18 exclusive. Dr. Robert Califf, the chief of the U.S. drug regulator, the U.S. FDA, no less, caught up with my colleague Ekta Batra on his maiden trip to India in his official capacity. Listen in to his thoughts on the U.S. government's concerns on over-reliance on India and China when it comes to drug manufacturing and a lot more.
One of the difficulties for us at the FDA is we don't control the economic issues, so it's much broader than the FDA. We only have a certain role to play. Our main job is to make sure that when a drug does come into the U.S. from outside, that it's safe and effective. The supply part of it, we do a lot to fix supply problems when they occur. But the question of what's the right balance is a very important one. This is being debated not so much within the U.S., but within other parts of the U.S. government. And I would just say in general, we all became overly reliant on China. I mean, China has been a growing country. They focus very much on the basic starting materials and the API, as you said. We need to see that distributed more around the world. India, I think in all of our planning, will be a dominant component of that. So it's not that we want to take it from India. What I see is the overall pie is getting bigger. India will maintain a very big part of that pie. But every country, including the U.S., should ensure that if something happens, that they have the capability, for national security reasons, of producing their own drugs. We've talked a lot about devices, too, while I've been here, another important part of your biomedical economy. You have a lot of very inventive people here, and a very similar story there. We would see the device and digital communities in India obviously very strong and growing. We just need to make sure U.S. doesn't depend completely on other countries, so if something happens, we have none of our own capability.
So will India be a dominant supplier to the U.S., say, 5 years from now? Can we still expect that?
I certainly expect that to be the case. I have no doubt about it. And, you know, we're celebrating the 15th year of our India office at the FDA. We have really talented and dedicated team here working with your industry. And I just loved a comment in a visit we made yesterday to one of the firms. I asked the question, how often should we inspect? Because we're going to inspect more. And it's not to punish the industry, it's more to develop a system where there are no surprises on any side. And the answer was, come anytime you want. That's the answer that we'd really like to see.
And will those inspections be unannounced? Will it be more independent translators? Because the US FDA seems to be facing that issue when it comes to India as well as China. announced inspections 12 or 9 weeks in advance, so they have time to prepare, and things such as translators who are not independent. So are those factors going to be considered now?
I feel like a real expert here because in my former life, I've been inspected by the FDA multiple times and on the boards of companies that have undergone inspections. And I think a mixture of announced and unannounced is important, and you'll see more unannounced inspections. Because as the gentleman said yesterday in one of the Indian firms, if you're always observing good practice, it shouldn't matter when an inspector comes. It's just your normal routine being observed. And we've seen in India that there's every capability of doing this at an extraordinarily high level. Also mentioned that digital technology could be very important here because a lot of what you need to know to assure that there's high quality now is being monitored within the firms with digital technology. In the future, we should be able to plug right into that digital information and keep track of the quality as we go. Then the inspections are very focused on issues where we may have concerns or want to learn about something.
Will the U.S. face a shortage because of the tornado hitting the Pfizer plant?
It looks like we've averted it. And I mean, one of the things about the FDA that I admire so much, remember, the commissioner is a political appointment and only for a short period of time. Most 18,000 people are full-time FDA employees who do this work. We have an entire team of people who do nothing but deal with the possibility of a drug shortage. And in this case, there was an immediate response. The company did a great job, and our people pitched in to make sure that we could recover as quickly as possible. If there's a shortage of one drug, there may be another that's just as good, or someone else may make it. All that involves our people at FDA and the industry working together. So we can handle this thing. And in fact, we're doing it about 200 times a year now in the U.S. And then about 30 to 40 times per year, a real shortage occurs. And I'm hoping that we can bring this to zero, taking into account all the things we've talked about today and fixing them.
So you've met a lot of people from industry in the past in your trip to India. When it comes to compliance, do you think that there's been a formidable change which has taken place? Because one of the key issues used to be data integrity, data falsification, which a lot of Indian companies were hit by, say, maybe a couple of years ago. Is that resolved and behind us?
I'd put it like this. A lot of the companies we've worked with for a long time have come up to a standard which is every bit as good as anywhere else in the world. And so we're seeing a lot of very high quality activity in the industry here in India. But you also have a lot of new people getting into the industry, and there's a significant learning curve there. And there's a real need, with your vast resources that you now have for education, there's a real need for training a large number of people who really start out with an understanding of all these disciplines that have to come together: chemistry, biology, human studies, medicine. It's a complicated set of issues where you need the whole team to be at the table in order for it to function. It's kind of like, I don't know, CNBC. You've got to have producers and anchors and the people rolling the film. They've all got to work together as a team, and that's what we need.
So particularly for compliance, and I take your point, particularly for compliance, a lot has to do with the top-down culture, from what emits from the management on the top and what goes down into the plant. Has that changed in India? Because a lot of the compliance issues we used to face was also related to the culture of the Indian people.
Well, you know, I'm almost 72. I feel like I've seen every situation, and I don't think there's anything unique about India. In other words, these problems exist everywhere, and I would react a little bit to top-down. I certainly believe that the leaders have to exude quality in their thinking and an absolute commitment to integrity. But there's also a very important bottom-up component of this. If the people who are in the workplace have a deep ethic of integrity and honesty, even if it hurts. That's also very important. So I don't think this is something that's unique to India, but there's a lot to work on here to get that balance right. And, simply put, it's something that happens in every business I've been involved in healthcare. I'm a doctor, and we've been through this in healthcare. What happens if someone makes a mistake? Do you cover it up, or do you talk about it and then fix the problem so that it doesn't occur again? And in a company, if there's a manufacturing problem, sometimes that puts severe strain on the finances of the company. And in every business, there's a tendency, if the bosses don't say, we have to be honest here, the workers are in a very difficult situation of speaking out, which is threatening their jobs. And so, again, not unique to India, but it's definitely an issue here, and I think it has gotten better. We've met with your leaders, not just your government officials, but your industry leaders while we've been here. One thing we want to do from our FDA perspective is reward the people who do display this commitment to integrity and quality.
All right, you can catch that full conversation with the US FDA Commissioner on CNBC-TV18 at 5:30 p.m. later today. We'll slip into a short break. On that note, the market's not too bad, actually. You have the mid-cap index, which is up over 200 points, and the Bank Nifty is also gaining about 200-odd points. So we'll take a break. Up next, Alap Patel and Harsh Patel of HLE Glascoat will be joining in to talk about the recent block deal, their acquisition of heat exchanger business of Kinam Engineering, and lots more. Stay tuned.
Welcome back. Well, the markets continue to hold in the green with a gain of close to around 40 points. But as promised, let's get straight to the next corporate we have on our radar. We have HLE Glascoat. That's a stock on our radar. The multiple trades that happened on the stock. There was a bit of a promoter sale. And also in the past, they've done some inorganic growth. To understand what's the way ahead from here, we're joined by Mr. Alap Patel, the Executive Director of HLE Glascoat. And in a short while from now, we'll have Harsh Patel as well, who joins in. Hi, Alap. Thanks so much for joining in. Well, both of you are here. Hi, Alap, as well as Harsh. Well, the street was buzzing about a possible QIP from HLE Glascoat. Now, that didn't happen. But your promoter entity has gone ahead and sold close to around 3.5% stake. So, two-part question. Will you sell more stake, or are you comfortable with the current holding? Point number one. And is that QIP that was talked about, is it off the cards?
Yeah, hi. Good morning, Nigel. So, see, it has been our long-standing goal to have quality institutional investors in our company. And, with this stake sale that has just happened, this goal has been partly fulfilled. So DSP, which is a very high quality institutional investor and a long only fund, we are extremely happy that we now have them as in our shareholders list. So while even with the QIP, our goal was partly to have high quality institutional investors and partly to have a war chest ready for organic and inorganic growth. And if you see with this DSP transaction happening, as well as the way we have structured our current acquisition of Kinam, both of these are exactly in the same direction. So while the QIP resolution, the enabling QIP resolution that we had expired in August, we just had one more QIP resolution that was passed in our AGM that happened yesterday. And again, the goal is to be ready for future organic and inorganic growth.
All right, Alap, but there's a difference, right? Because now the promoter entity will get the money. Earlier, if you did a QIP, the company would get the money. So how are your books looking right now? I mean, you have an inorganic growth as well that we're looking at. Could you tell us what is the balance sheet looking like? And how do you fund this inorganic growth that you'll be looking at?
So this Kinam, acquisition of a controlling interest in Kinam Engineering Industries, which we just recently completed. So this transaction was planned to happen in two phases. So the first phase we completed just earlier this week. So we completed the acquisition of 35% stake in Kinam in cash consideration. And the remaining is to be acquired through allocation of shares, which will happen via an NCLT scheme of arrangement. And that will happen in due course, subject to all the regulations, all the regulatory approvals coming in.
Got it.
So while while obviously the QIP and the DSP transaction are different in nature, like you said, the end goal for us was through the QIP also to have quality institutional investors coming into the company. And we very strongly believe that once DSP has come in, this also opens doors for other quality institutional investors to participate, which will increase the depth in the market for our stock. And this augurs well for long-term value creation for our shareholders.
So Alap, just to complete this discussion on the promoter holding, etc. Earlier you had told us that promoter holding will not fall below 66%. Do you hold on to that?
Yes. So currently we have a very high promoter shareholding of close to 70%. With this transaction happening, it will bring that down marginally by about 3.5%. So nothing really changes in terms of the promoter interest in the company, or no dramatic impact on the promoter stake in the company as well.
Got it. Okay, got it. Let's also get Harsh into this discussion. Harsh, thanks for waiting by patiently. Wanted to understand what is the scope of business, right, over the next 12 to 18 months. Your order book as of the last quarter is a little over 550 crores. What's the order visibility like, and what are the demand trends? If you can give us the numbers.
Right. Good morning, everyone. Yes, the order book stood at 500 crores last quarter, and we have continued booking order at a similar rate. So the order book is looking very, very healthy currently. We are also all set to achieve our said target of around 1100 to 1150 crore for this financial year on a consolidated basis. So the markets are looking good, especially the API sector is pulling the weight right now. So things are looking very positive currently.
Okay. Gentlemen, good morning. Alap, how is the acquisition of Thalitic going? I mean, if you can tell us. Have you been able to expand the product portfolio there into the US? Have you been able to take the products there, bring it here in India? I think there were plans to reduce costs by making components here in India for that business. Has that started? Just give us a sense.
Yeah. So we did the Thalitic acquisition about a year and a half ago. Now the Thalitic acquisition has turned out really well for us. So on all the three areas where we wanted to make progress, we have made significant progress. So after receiving the regulatory approvals, extensive technology transfer exercise has been undertaken. We are now ready to manufacture the Thalitic products in India, and the products have also been launched in the Indian market. As far as the US market, as far as our foray into the US market goes, our business development exercises there began a few quarters ago, and we are happy to report that that has also yielded very good results. As of the end of July, we have close to 9.5 million US dollars worth of orders in the US. So that has gone on very well. And also the exercise for supply chain integration, or rather sourcing from India for the European market, is progressing well. And we are now beginning to source components that are either sourced from vendors in India or partly manufactured in India, as with the intention to bring down costs, overall manufacturing costs for our organization.
Okay, so then if you can share some numbers with us, once you start, you said you're about to start manufacturing these components here, right? Or sourcing them through vendors, all of that sort of back end is done. What are margins now at Thalatic? What can they go up to? And overall, as revenues from that business, what can they go up to? Because you're saying you've started booking orders in the US as well, almost $10 million as at the end of July. What is the scope of that business and margins? Go on.
Sure. So currently the margins in the Thalatic business are in the 12.5% range. We believe that margins in this entity could be in the 14% range going forward. And this would be partly fueled by some of the sourcing exercises that we do. So while we have initiated exercise to source some components from the Indian market or from low-cost markets, I think we have said repeatedly that we want to retain the core made in Germany value proposition of the Thalatic product. So I think a margin somewhere in the 14% range should be doable.
What about revenues, Alap?
So last year we did about 33 million euros, and we are expecting that the German business this year will grow in the 15% range.
Okay, all right, got it. Gentlemen, the stock price has come down and it's nearly half of what it was at its peak. So clearly your investors will be listening into this conversation and they'll be looking at this inorganic growth as well. In particular, I'm talking about the Kinam Engineering Industries. That growth in that business has been phenomenal. From 50-60 crores, it's more than doubled in just 2 years. How do you see the revenues of this acquired entity scale up? Point number one. And point number two, at the start of this conversation, you said 35% is done. The remaining 35% will be done in the coming time. When does it happen? Sometime in FY24 or FY25?
So
the acquisition of the remaining 35%, the timeline that we see is in the next 9 months or so. However, we will begin to consolidate the numbers from Kinam into our numbers beginning 26th of September, which is when the first leg of the transaction has been completed. And of course, this will be to the extent of our stake in the company.
Okay, all right. And what about scaling up of that business? So in the next 9 months or so, you'll move to 70% from the 35%. You'll start accounting from it from now itself. But could you tell us, what about the scaling up of this business? Because otherwise, if I derive the numbers, you've got it around little more than 1-time sales, forward sales, I'm guessing. Going by, there could be some growth out there. So can you hit, say, 150 crores in this business in FY24, and then it scales up from there? What is the total revenue capacity?
So, Kinam Engineering.
Oopsie, I think Kalap's line is frozen. Harsh, you want to take that?
Yeah,
if you're on a better. Yeah.
So Kinam Engineering, I think this year, we are confident that we'll achieve sales in the range of 150 to 170 crore. So, and Kinam has just added a manufacturing facility last year. So we will the capacity to scale up even beyond that, up to around 300 crore is there from a manufacturing point of view. And with the synergies that this acquisition brings in for both Kinam and HLE, we believe that we can grow this business to that extent in the coming 3 or 4 years, while maintaining a similar growth rate and similar margins. So we are very positive about this acquisition and the business of Kinam.
Okay, and all the best with that. I just have a couple of more numbers I want from you. Currently, I think you're sitting on a debt of a little under 300 crores, Harsh. If you want to tell us what is the plan, do you plan to reduce debt further, and what will it be after 12 months?
If you see us historically, despite acquisitions and expansions, we have always maintained a debt ratio between 0.8 and 1.25. So, despite the Kinam acquisition and everything happening, we will be maintaining the debt equity ratio in that range. So that is very, very manageable and very healthy ratio that we think we can maintain.
Okay, and on the margin front, over the last, I mean, you briefly mentioned it a while back, but over the last couple of quarters, your margins have been under pressure. Even in Q1, if you look at it, the margins were the lowest that we've seen in the last 4 or 5 quarters. Do you expect a recovery, and what would the margin trajectory look like over the next 1 to 2 years?
Yeah, so like I said when we spoke last time, the low margins that you see in the last quarter are mainly because of the way our orders have been spread out. So we book our margins only when we dispatch or when we account sales. So what happens is if some sales are pushed into a different quarter, the margins appear low because the manufacturing activities and the costs have remained, but the sales are actually pushed back in the next quarter. So that is the main reason, primary reason for the low margins that you see in the Q1. And that has been historically so, if you check. We will recover the margins. And in India business, we expect the margins to be, on a consolidated basis, the margins to be in the range of 16 to 18%. And I think, as Alap said, in the German business and in the international business, we will be closing around 14% in margins. So we will end with good margins by the end of the year.
So consolidated will be around 15, 16%?
Yes, we expect. For India, it will be that range. And Yes, that should be the range. Yes, you're right.
15, 16%.
Yes, 15, 16%.
Okay, margins is one point, growth is another point. But what about working capital? The number of days has gone up drastically. Give us a guidance on working capital days from here on.
Yeah, I think, Nigel, it is linked to what I just said. What happens is that since the sales has been pushed back to Q2 and Q3, what you see is that the WIP is very high. And WIP very high, since the WIP is very high, then the number of days looks high. And hence the receivable also is high. But by the time we end the year, all these orders will be dispatched. And we also have a very healthy order book. And we are expecting that 1,100 crore top line. So this will normalize. This will by the end of the year.
To what level? Working capital days will normalize at the end of the...
75 days, what it has been historically, 70, 75 days in that.
70, 75 days. Final question, gentlemen, before we let you all go. It's like the street was confident about your delivery, say, in FY23. Now, FY24, you'll have done another inorganic growth as well. FY25 appears to be the big year for you all. From this 1,150 crores, with this Kinam acquisition, the Thelatic acquisition as well coming on board, what could revenues look like for FY25? And most of these supply side issues as well will get sorted out. And margins will perk up. So what is the guidance for FY25 at current juncture?
So, Nigel, we are expecting the growth to be in the range of 18 to 20% in this period. And I think we will improve the margins by a couple of percentage points for FY25. That is the guidance.
18 to 20% on 1,100 crores because you'll have this inorganic growth as well, right? Kinam will be coming on.
Yes.
So you will be in that vicinity of around 1,350 to 1,400 crores, 2025.
That is the expectation, yes.
And margins improve by 100 to 200 basis points from here?
Roughly, yes. That is the goal at least.
Okay, all right, Alap and Harsh, thanks a lot for joining in and appreciate your time here on CNBC-TV18. That's HLE Glascoat with the outlook on the business and the way forward over the next couple of years post the acquisitions that they've made. But let's focus on some of the stocks on the move. MCX is down 7% now. Sudarshan is tracking the stock for us. Sudarshan, over to you.
MCX announced yesterday that it would go live on new technology platform from October 3. And on back of that, the stock saw a huge jump and hit record high. Now within 24 hours, there is another update to that. The regulator SEBI has advised the company to keep the implementation of new platform in abeyance. SEBI has cited the reason of writ petitions filed by Chennai Financial Markets and Accountability, which is pending before Madras High Court for the disposal. SEBI says, since this matter involves technical issues, it will discuss this in upcoming Technical Advisory Committee meeting that will be held soon.
Okay, all right. Thanks a lot for that, Sudarshan. By the way, L&T Finance Holdings, that stock has perked up in the last few minutes. I think the intraday chart should come up for you. L&T Finance Holdings and Mahindra Financial, as both of them are moving very, very well, and volumes as well, very, very good. But clearly the stock of the morning has to be Navin Fluorine. It was down 10%. It pulled back a little bit, but as we speak, it's down close to around 13%. A big resignation at the top, and the street doesn't like it. Sonal joins us to fill us in with more on that. Sonal?
Thank you so much for that. Well, the street was betting on the MD, that is Mr. Rajesh Welling, and that's why this disappointment has come by. As we've been highlighting, the stock is reacting negatively to this because the MD has resigned with effect from 15 December, and in the interim, Vishal Mafatlal will steer the operations of the company. Mr. Welling joined the company in October 2018, and since then, the company has seen massive growth across operations. In fact, their revenues, they grew from around 900 crore rupees in FY18 to more than 2,000 crore rupees in FY23. Profits also increased from 180 crore rupees to 375 crore rupees in FY23 itself. And after a big gap, the company did see or come in the capex mode because it was led by him. So they had planned capex of around 1,700 to 1,800 crore rupees till calendar year 2025, and that is what the street was betting on as well. In fact, Navin Fluorine was one of the companies that did well, few of the companies I would say, in a very weak Q1 where across the globe companies saw a lot of headwinds. That is when the company said that they are not seeing any impact of inventory destocking on business. They are identifying several late stage opportunities in CDMO, and FY25 growth plans are on track as well. This is when a lot of companies had cut their growth guidance. But the other fear that the street has is a lot of recent resignations at the top, which is happening at Navin Fluorine. In fact, in August itself, the CEO of the company, Mr. Ravi Venkatraman, he had resigned. And Mr. Rajendra Sahu, he had taken over in the interim as well. But this was a big resignation that came by in the CDMO business, which is a growth driver. In July 2022, the CFO had resigned and he was reinstated in Feb 2023. The position that is by Mr. Anish Ganatra. Morgan Stanley has written on the back of this resignation. They say they expect to hear more from the company on how it plans to tackle top management attrition, because that continues to be an issue for the company. All right, thanks a lot, Sonal, for that. That's on Navin Fluorine. But Tube Investments is the other stock that's losing in trade. Nimesh is tracking that stock. Nimesh, over to you.
I said the stock is down 4% on the back of a large block. So 1% equity got changed hands in a deal worth 570 crores. Now, what I understand, the promoter entity was a seller in today's block deal. But do remember, this is all part of the family settlement. If you remember last week, there was a large block in Chola Holding as well, where Amandi Enterprises sold. So as I said, this even stake in today's block, the promoter entity was a seller and some domestic mutual funds were buyers, is what I understand. I was just looking at valuations. I was looking at the Moti note. According to that Moti note, the stock is trading at 40 times FY24 and close to 33 times FY25 estimated consolidated EPS. So stock not cheap, but this 1% block is largely on the back of family settlement within the Murugappa group.
Okay, thanks a lot for that. So that's on Tube Investments. But look at the market. It's picking up pace now, so that's not bad at all. The mid-cap index is now up almost 300-odd points, and the Bank Nifty is up 260 points. A lot of stocks actually hitting fresh 52-week highs. So just want to mark some of them. Aurobindo Pharma is at a fresh 52-week high. Coal India, L&T, REC, NTPC. This entire power and infrastructure space has done very well. In fact, NTPC is at a record high. Mitesh Thakkar is back with us. Mitesh, what are you looking at in terms of individual stocks now?
So I think Syngene is something which has given a good reversal. It was buy earlier as well and didn't fall, I think, in yesterday's decline, and now it's picking up pace. So I recommend buying here with a stop at 778 for targets of 810. And the other one is Wipro. I think the IT package is slightly weak, and Wipro looks to be one of the most underperforming stocks. So that's a sell with a stop at 406 for targets of 390.
Okay, all right, Mitesh, thanks a lot for that. Well, for the time being, though, we'll slip into a short break. The equity markets are doing well. On the other side, we'll put the focus on the commodity markets. Manisha Gupta will be coming in.
High blood pressure and high cholesterol, like most men my age. I'm almost 72 now. And I'm very dependent on 4 generic drugs that probably do come from India, and we all became overly reliant on China.
Will India be a dominant supplier to the US, say 5 years from now? Can we still expect that?
I certainly expect that to be the case. You need the whole team to be at the table in order for it to function. It's kind of like CNBC. You've got to have producers and anchors and the people rolling the film. They've all got to work together.
Welcome back. Markets holding above that 19,600 odd mark today had all the ingredients to be a good session, and it started off on a good note. Though we'll be keeping an eye out on the 20 DMA, which is at around 19,750 odd. So no worries on the equity markets. Let's find out what's going on in the commodity space. Manisha Gupta joins us to tell us exactly about that. Morning, Manisha.
Thank you for that, Nigel. I don't know how much support can commodities do when it comes to equities, but clearly the crude oil prices decline can be all the support that those markets need as well. So we are looking at a percentage point of decline overnight, and this is a profit taking that has been much awaited because the crude oil prices have been moving in one direction. It has been overbought. Remember, we've seen nearly 10% of gains come in for the crude oil prices in last 1 month, and it also has been the best quarterly gain that we are trading at for this quarter since early 2022. So even with profit taking, we are holding nearly 27 to 29% on the higher side for both crude varieties, and it is the best quarterly gain, as I said, in a couple of years when it comes to the crude prices there. The profit taking also comes in on back of a couple of things. One, the crude for the longest time has been ignoring the dollar index at a 10-month high, so markets taking a cognizance of that. The other thing is that you're also looking at the China Golden Week, so there could be support demand coming in from that holiday travel there. That is a number that the street will keep an eye on. And apart from that, the US data has been on the supportive side as well. We've seen August better than July, and the street is anticipating that September could actually give you even better numbers coming in, and that has been supportive for the prices. What is not supportive is the fact that you are looking at Russia now saying that they will ease out the export bans sooner, and the export bans are not expected to be very restrictive. So that tells you that there could be more supplies coming into the market. Apart from that, it is going to be about the US personal consumption data that comes in today. The China factory activity data comes in on Saturday. And then you have the OPEC meeting. Well, that's on 4th of October. And markets will keep a keen eye on that, on what is the sense now on the monthly demand and supply numbers, and of course the view going forward for the fourth quarter of the calendar year as well. Having said that, the markets do believe that $90 as of now is a strong support going forward. On the higher side, it is still open for spikes to that $100 a barrel mark.
Okay, all right, Manisha, thanks a lot for that. For the time being, though, we'll slip into a short break. On the other side, our special segment, It's the Economy. Lata will be chatting with Mr. Umesh Rivankar, the Executive Vice Chairman at Shriram Finance, and also Mr. Karthik of ICRA, to put the focus on credit demand picture amidst the festive season. You don't want to miss this one.
Welcome to It's the Economy. This is a special ahead of the festive season. Now, the sector-wise growth in bank credit data released by the Reserve Bank yesterday shows a very mixed picture. Overall, credit has grown at 14.9% in August 23 over August 22, but it is slower than the 15.5 in the previous August over August. But within this, loans to transport operators and vehicles are two sub-elements that have done better this August compared to the previous August. And gold loans have absolutely gone through the roof. The numbers will come up for you. Personal loans, however, have slowed a bit. To get an idea of how things are shaping up in the festive season in terms of bank credit, and moreover, how things are shaping up for the NBFC space, I have with Mr. Umesh Revankar, Executive Vice Chairman, Shriram Finance, and A.M. Karthik, the Vice President and Co-Group Head of the Financial Sector Ratings at ICRA, to give us an industry perspective. Gentlemen, thank you very much for your time. Mr. Revankar, if you can give us an idea of how things are shaping up in terms of demand. Bank credit appears to be slower, but overall credit for NBFC, would it be higher in the current quarter compared to the year ago quarter?
Yeah, Lata, it will be better than the previous year, mainly because, in between, August was little weaker because of the uncertainty in the monsoon, but September, it has caught up. The rains have been there all across, except for probably South Karnataka, where there is less rains. But rest of the place, the rains have caught up, even including Madhya Pradesh and central India. The rains have caught up. So the credit demand has improved in the month of September. So overall, this quarter should be good quarter for everyone.
All right. Oh, so maybe August is a one-off month. For banks, it is very clear that the growth is slower. I mean, 14.9 is a good number, but it is slower than the 15.5 that the previous August showed. What would your views be, Karthik? Are you getting a sense that even for the NBFC sector, overall credit would have slowed, albeit a little?
Yeah, thank you. We expect at least the credit growth to remain strong in absolute terms. We could see some moderation in percentage terms with the base effect coming from the last year. But in absolute terms, we do expect the volumes that we clocked possibly in the last financial year, same quarter, we expect to do the same, at least in this quarter. Last year, I mean, we ended the last financial year with a strong 22% overall growth in the retail credit of NBFCs. Over that 22% growth,
one minute, Karthik, 20% is what number? It is overall retail credit growth by NBFCs?
Yes.
Okay.
Yes.
And this year, that 20% is very strong. You are expecting FY24 to be as good?
In absolute terms, yes. But in percentage terms, it will look a bit lower at about 16 to 18%. So you would clock the same absolute credit growth, but the percentage will look a bit different. So that's the thing that we'll have to keep in mind.
Okay. Yeah, but absolute is not good enough. It's a larger economy and there is inflation more than anything else. So if it's only absolute, then it's a little less. But Mr. Revankar, sector-wise, which is the one that's doing exceptionally well and which is lagging? Because clearly in bank credit, August appears to have lagged. And gold loans is the one that's gone through the roof. How is it for you?
In the commercial vehicle, demand has been good throughout, except for, I believe, the little slowdown in the smaller vehicles, LCVs. There is a lesser growth year on year. But heavy commercial vehicle, construction-related vehicle or equipment, the demand is quite good. The rural demand has come back in the month of September. So definitely, I think October, it will continue to be good. And October, November being the festive season. And the agri output coming out in the month of October, November, that will give reason for better consumption, better demand for the Rabi activity. Ultimately, whatever the income generated in the Kharif crop that gets back into the investment of Rabi crop. So that's the process happens in October, November, and plus the festive season where you buy new items, new clothes, or sometimes even a lot of new vehicles also. The demand comes in this period because it's an auspicious time to buy new assets and equipment in our home or business. So all those things should really help. So I think with the better month in September, the October, November should look very good.
Okay, y'all did, I think, 18% last year in terms of AUM growth. I mean, in Q1. Would it be the same YOY growth full year?
It's almost, yeah. We did guide 15%, but the way it is going right now, it looks like we should be at 18% AUM growth.
Okay. What about margins, Mr. Revankar? Would you be able to do better in terms of spreads than last year?
Margins would remain at the first quarter level at around 8.3 level. There may not be increase in margin because we do expect the interest rate to further inch up in the next couple of quarters by 10 to 15 basis point. I don't really think, because the inflation concern is still there. So RBI and would be little focusing on controlling the inflation. So I don't really see ease of the interest rate or interest rate coming down. Rather, it may go up by 10 to 15 basis points.
No, bank margins. Bank margins. So bank margins are clearly 20-30 basis points lower in Q2 because they also had that ICRR, incremental cash reserve ratio issue. And there was genuine tightening during September as well, advanced tax. I mean, RBI wantonly kept it tight. Will you all also see this kind of a 20-30 basis points fall in margins?
I don't really think 20-30%, but 15% somewhere in around should be the impact on the margins.
Okay. What's your sense, Karthik? Are NBFCs more generally going to face as much margin pressure as banks, or will it be much less for them?
Within the NBFCs, I think we'll have to break it up between entities who have floating rate loans, essentially the mortgage lenders, and the fixed rate lenders, specifically vehicle finance and so on and so forth. So for the whole year, for the fixed rate lenders, we do factor in, at least for our projections internally, we do factor in a 30 to 40 basis point contraction in the NIMs. But there will be some benefit that they will get from the credit cost part. And overall, the profitability might not go down to that extent. It could be going down only to the extent of about 20 basis points. This is for the fixed rate lenders. For the floating rate lenders, especially the housing loan product, we don't expect any major margin contraction because there will be a good amount of pass-through which will happen. So it's a split between the two. We'll
so
have
the
to look
fixed
at
loan guys. So fixed loan guys may find about 15 basis points lower margins, you're saying. That squares with what Mr. Revankar is also guessing. Mr. Revankar, now for asset quality. The personal loans have gone down a bit. The rate of growth, that is, not aggregate, rate of growth is slightly slower. But gold loans have gone up really strong. And we have seen the Reserve Bank repeatedly say they are worried about this extraordinary growth. Is there an asset quality worry, especially unsecured and in gold, although it is secured?
Yeah, the RBI has been cautioning on unsecured, and therefore I think the banks or even NBFCs would have tightened their norms, credit norms, and that would have slowed down the growth in the unsecured lending. But as far as gold, I don't really see a challenge. As long as you lend up to 75% on LTV, there should not be any challenge on the gold. And I think the activity around gold loan has increased multifold. Everyone trying to get into the segment because it is a very safe, short-term repayment and very consistent the repayment and asset quality. I think many more banks have joined and opened up the gold loan. I think all those things, they have reason for gold loan being expanded and being accepted as a much easier and lower rate borrowing for the people. So I think by and large, gold loan is getting the reach what it should have been in the past. I think in the past, the banks were restrictive on the gold loans by not keeping the office open beyond 2 and all, which now most of the banks are trying to make it open for the public. So that's the reason the reach has increased, and people are using this opportunity to lap up or increase the gold loan portion instead of.
Okay. No, it's just, but you're not worried about unsecured loan in others other than gold?
No, we are not, because we believe that, see, most of the NBFCs, especially banks and NBFCs, they have improved their credit norms, tightened, a lot of data being available now. So I think everybody is cautious on their lending. Underwriting practices have improved significantly among NBFC and banks, and I don't really see a challenge.
Well, it's more a credit cycle also that is benign. But your thoughts, Karthik, on this? Any worries about quality of unsecured credit? I think Sibyl pointed out that loans under 50,000 rupees were showing a higher amount of days past due. But that was an old report. Do you see any unsecured credit worries?
The segment has grown quite sharply last year, and this year also we expect a very strong growth in the unsecured loans. The segment is fairly well pricing in the risks that are underlying the credit, and while we might see some delinquencies around it, this is largely priced in the way that the lenders are underwriting. So the rates are higher, the processing fee that goes with is higher. So there could be losses, but this is largely priced in. And I agree, the underwriting norms have gone up fairly well. And at a systemic level, the unsecured loans is still a very small component. I think it's less than 10% of the overall systemic credit, both in the
I'm not
put together.
No, Karthik, I'm not saying it is going to be a system problem, but I still wanted your view on, you wrote an extremely bullish report in July 2023, raising the credit growth pace of the NBFC space. Are you still as bullish on the sector? Do you stand by most of the numbers of that report?
Yeah, of course. I mean, growth and performance numbers, we do stand by whatever has come out in July. The numbers will hold up, is what our expectations are.
All right. Okay, on that optimistic note, Mr. Nivankar and Karthik, thank you very much for joining this conversation. So, just a small fall in the pace of growth in bank credit. The NBFC guys are not that worried at all. There could be a slight slowdown in the pace of growth of overall credit, but doing extremely well in gold loans and in commercial vehicle loans. So August may have been an aberration. Margins also expected to be about 10-15 basis points lower, but otherwise strong on growth. We wrap up on Bazaar. Chartbusters coming up.